Well, welcome back to another episode of Not Done. I'm Sloan Dean, and today I've got my first ever repeat guest, my good friend Ryan Meliker, co-founder of LARC and the most accurate industry forecaster in the hotel biz. Welcome back, Ryan.
Thanks. Pleasure to be here again.
Ryan, well, I think you were on the show in February. We were kind of doing an end of 2025 rundown and looking out to 2026, which at the time looked a little sadder, right? There was, a lot of unknowns. And then fast forward, we have a substantial outperformance in Q1, which I don't think anybody saw. I definitely didn't see it coming. What happened in Q1?
It's a great question. January and February performed very similar to our expectations.
Okay.
But for some reason, March and even since then, April and a little bit of May massively exceeded expectations. Despite the war in Iran, oil prices so high, a partial government shutdown, all these things that should have created more headwinds, yet we've really outperformed. Now, if you go back to what we talked about in February, I had always said, well, hey, things are going to get better in the second quarter, driven by what I, at that point in time,
Easier
referred to as,
comps, right? Because we had a
yeah, three
really
factors.
crappy
You got it.
April last year.
Yeah, easier comps was one. Number two was the SALT tax relief benefits. And then number three was ultimately the World Cup in June. Were the three reasons why we started to see things getting better in the second quarter. So why did they start to get better in March and even better in April than we had anticipated? Maybe those SALT relief efforts started to show up in consumer balance sheets a little earlier than we had expected. I can tell you that I have spoken to, over the past, call it 2 to 3 months, my counterparts at maybe the 15 largest hotel operators in the US who are our clients, and everyone's trying to make sense of what happened because nobody saw it coming. I think it's driven by a few factors. Number one is that SALT tax relief I just mentioned. Number two is we've actually seen corporate demand being far more resilient than expected, given really muted GDP growth. 1Q came in at just 1.6% growth and basically no job growth. And I think that's tied to a couple of things. Number one is companies are much more focused on kind of their stock prices and trying to boost revenues in the face of stocks moving so much higher tied to AI, really focused on that. They've also proven to get a little numb to all of the administration's up and down policies, right? What are the tariffs going to be? Maybe we don't care anymore what the tariffs are going to be. We just have to
Right.
move past this. War in Iran. Okay, this isn't going to be long term. I can't focus on that. I need to focus on government shutdown. Not going to drive my business. I need to move past it. I have to get out and do this. After a year of all that uncertainty, I think companies have started to get a little more numb to that, which is a good thing for our business from a corporate transient perspective. Obviously, group has been strong. It's something that we've identified before. It's still tracking really well, up 4% this year versus last year. High-end leisure has also been doing well. Nothing surprising there. That continues to be more of the same, fueled by that wealth effect from the stock market. And but then the other two things that I think could have played out in March and April that really drove some of that outperformance is what I like to refer to as revenge travel 2.0. If you remember, there was revenge travel coming out of the pandemic, ready to get on the road and travel. Well, guess what? Leisure travel in summer 2025 was one of the worst summers we've had. You get into March and oh my God, we just went into war. Gas prices are spiking. Oil's going up. Airfare is going to be a shock to the system this summer. If I don't get out and get a vacation now, it may not happen this year. I can't not go again. So there was a little bit of that pent-up demand, coupled with a pull forward of that demand from the summer because of those rising transit prices from gas prices and airfare. So I think all of that together led to a stronger March and April than maybe we had expected. In February, I don't know that it's necessarily permanent, but we think there's a lot of silver linings too.
Yeah. Well, you guys, I'm looking. Now, this will publish after your new numbers come out, but your RevPAR forecast for the full year went up substantially. I think you're releasing that next week at NYU right before this podcast comes out, and you have it stepping up to 3.4%. A material increase from where you had it when we were talking. And obviously you've got, what baked into that number, at least 4 months of actuals. It seems like that then you're thinking this continues, right?
Yeah, I think to an extent. Look, we had always said that 2Q and 3Q were going to be much stronger than in 2026 than 2025. I think, when you layer in kind of a little bit more corporate transient certainty with corporate transient performing better, it compounds that effect. And now our view, I would be clear, it's 3.4% RevPAR growth. It's fueled entirely by ADR.
Got it.
We do not think it's coming in the form of occupancy at all. It's being driven by, when the industry's starting to feel a little bit better about fundamentals, you start to be a little bit more aggressive on ADR. I refer to as the human component of revenue management, starting to push things a little bit more aggressively. And again, it comes down to, that, as I mentioned before, that high-end leisure travelers performing really well, group is really strong, and corporate transient is holding up. It's the low-end leisure traveler that's a little softer, the middle class and the lower class, where the K-shaped economy, inflation accelerating, real disposable personal income at the lowest level in 5 years. Those types of things compound. You've got personal savings rates going down, credit moving higher as the middle class consumer is dipping into credit cards a little bit more, taking out bigger loans tied to autos and things like that. I mean, the reality is we're basically at accelerating delinquencies on student loans, credit card loans, subprime loans, you name it. These are not good things, and it's certainly weighing on the low-end consumer. It's not the high-end consumer driving that; it's the middle
Right.
class and lower end.
Yeah, two things that are kind of quandaries to me that I would think have influence. To build on that, call it the bottom half of the United States, or even the bottom 70, 80% from an income net worth perspective, you are seeing credit card debt on the rise, as you said. The other thing that I think really hurts them disproportionately is you have gas prices, right? It's kind of a bellwether for other inflationary costs at all-time highs. You would think that would hurt drive to leisure this summer, you would think. But at least the early data in May suggests like there's not been an effect. I'm curious what you think of like gas prices and its impact or non-impact on summer leisure.
Yeah, I think it's going to have a big impact. I mean, we talked about, I thought, a little bit of a pull forward of summer demand,
Yeah.
March, April, because of those costs. I would totally agree with you that a lot of those drive-to leisure destinations will be a little bit more challenged this summer. Because of that, I also think that not only from gas prices, but I also think from the World Cup, people may choose to say, hey, let's go do the trip to see the World Cup in New York or Philadelphia or Boston or Kansas City or Dallas or Seattle or San Francisco or LA, as opposed to that trip to Virginia Beach or Myrtle Beach or one of those other places, because this is a once in a lifetime opportunity to be able to drive and go see the World Cup matches.
Yeah, so let's
Yeah.
talk about World Cup. I just had a conversation with some hoteliers in San Francisco. They're close to Levi's Stadium. They said they've seen little to no pickup. And then I live here in Dallas, which is the media hub, has 9 games. FIFA canceled a lot of their room blocks across the city. At least anecdotally, what I've heard is that bookings are not paced to expectation. At least what's on the books is indicating it's going to be an underperformance story. Now, I think part of that is too, you have very little foreign inbound coming in. So are we going to just see this domestic surge around World Cup?
So here's our view, and our view hasn't really changed. So much of it comes down to what your expectations were. Our expectations going back 18 months ago were that the World Cup would have zero impact on occupancy. It was not a demand story. It was all an ADR story. That you raise rates aggressively during special events like this, and people will pay for it. And it will circumvent other demand because pricing is so high. Continue to hear anecdotally that's what's happening. Pricing is staying super aggressive. A lot of the tickets for the World Cup, given the pricing, are going corporate. And you're seeing a lot of demand tied to corporate, where a lot of those bookings will happen later on from a hotel perspective. But when corporates are blocking boxes and suites and whatnot, you'll have plenty of people coming in that will pay premium for hotels at those points in time. Our view has always been it's much more of an ADR story than an occupancy story. In fact, the analysis that we had done on Russia back in 2018, which is the closest comparable we had, suggested that all of the performance in Russia was tied to ADR and none of it was tied to occupancy, which kind of helped formulate those views. I think it's interesting you mentioned San Francisco and Levi's Stadium. San Francisco, unfortunately, we've looked at their schedule. They don't have a single good match. They've got Qatar versus Switzerland, Austria versus Jordan, Jordan versus Algeria, and Paraguay versus Australia. I don't think that you're not going to get a lot of travelers for those matches. What I think is much more interesting is the comment you made earlier about the room block cancellations. You've seen this across several cities, and the question that I don't know the answer to this, but the question I pose is, well, did FIFA just block way more rooms than they needed? Why was FIFA blocking that many rooms? Most people, when travelers, get the tourists that are going to visit the games aren't part of a FIFA room block, right? So who was FIFA blocking all these rooms for that they no longer needed, and why did they overblock?
I have yet to hear a good answer to that. Have you?
Yeah. No, I don't know. But I think the cities should have been asking those questions when they were giving these room blocks.
Well, sticking with this kind of is pivoting off of World Cup macro conditions. I guess if I go to the job numbers, you reference them. If you look at the most recent numbers, and I'm quoting, 7 of 13 major job sectors are declining. What do you make of the current labor market?
It sucks. We have a really, really soft labor market, you know?
Well, don't you
We
don't you think though that just continues because AI will lead to job destruction, right?
Well, I think it continues for two reasons. Number one is the labor pool is shrinking with all the immigration enforcement, and we have fewer immigrants coming to the U.S. and people that were part of the labor pool being deported. That certainly impacts the labor pool, number one. Number two is, yes, I think AI. Now, I would argue that I think at this point in time, AI isn't replacing people. It will replace people. Companies like Amazon say they're laying off people because of AI. At the end of the day, over the past year, there are dozens of public companies that have announced layoffs and blamed AI. And the reality is, normally, when a company announces layoffs, it's a negative. But when you announce layoffs and blame AI, it was a positive and the stocks rallied. Right? Oh, they're going to be more efficient now. So it became the bellwether. Anytime you were going to have any type of layoff or restructuring, just say it's AI related. And that's what happened over the past 12 months. There's not a single public company announcing layoffs that isn't blaming AI today.
Yeah,
Whether
that's
they
true.
are, whether, it could be Amazon in a distribution center, AI isn't replacing the people in the distribution center yet. We don't have physical robots using AI at that level yet. It will happen, don't get me wrong, but it's not there yet. So I think so much of it has more been, it's been an excuse, but more importantly, it's been a reason not to hire. I want to hire people today if a year from now or 2 years from now I can replace them with AI. I don't want to spend the money to bring people on and get them trained and then lay them off in 6 or 12 months if they've been trained. It doesn't make sense. So it's had a huge impact on the hiring component more so than, in my view, the layoffs.
Well, I think so. You just termed the labor market stinks right now. How is that then impacting hotels?
So this is a great question. Historically, over time, if you go back over the last 25 years, job growth, particularly office jobs, is one of the highest factors that drives corporate transient demand. When companies are growing, companies are spending more money to generate revenues and go out on the road, sales. So when you don't have the job growth, it limits the growth of corporate transient. That's the biggest headwind that we've seen, and that's kind of been our concern. However, the reality is most of those corporate transient travelers are not those entry level employees that may be getting laid off by AI or may not be getting hired because of AI. So you're not necessarily having as much of an impact on corporate transient travel as you might normally in that environment. I think it's an interesting dynamic where we don't see a boon to corporate transient anytime soon, but at the same time, this anemic job growth where we're looking at, sub 50,000 jobs per month in good months over the past few, it's not necessarily a huge headwind either. But I think it's really hard if you're middle class, I think you run into two challenges. Number one, it's really hard to find a new job, right? Because there just aren't a lot of companies out there hiring. And number two is if your employer knows that it's hard for you to find a new job, they're not so inclined to give you big raises. And when
Right.
inflation is going up and cost of living is rising in a meaningful way, and you're not getting that offset with increased wages, that impacts your disposable income for things like leisure travel. And that's why the middle class, the lower class are feeling so much pressure from a leisure perspective and a travel perspective. And we're seeing those numbers at the low end of the chain scales not performing super.
Yeah. Yeah. Interesting. The follow on that, consumer sentiment in March hit 53.3. That's the lowest number since 1980 if you take out the pandemic. How the heck do we reconcile that terrible consumer sentiment? It almost seems like a bit of a disconnect. Like you tell me that consumer sentiment number in March, and then we had this April. I'm having a tough time reconciling how consumer sentiment is so poor and we're seeing an outperformance in travel demand.
It is. And actually, the April number came out and it was even lower. So it's
Yeah, it
continued to
even got,
drop.
yeah, thank you. Yeah, I was going to say it did. It was even worse, which is
Yeah.
like befuddling.
Yeah, so I would agree. I think there's two things that I'll tell you is number one is the consumer sentiment index has basically skewed to the downside, over the past 10 years or so. So I think it's hard to fully compare today's numbers to 1980. That being said, I think the trend is still pretty clear that things are really bad. And a lot of it comes down to that dynamic. The majority of the US population is struggling, but that majority aren't the ones traveling and staying in hotels
Yeah.
across the country. Companies are still traveling, the low end continues to struggle. I don't know that this is a sustainable dynamic for an extended period of time. How can this last if the middle class and lower class are really struggling? Isn't that ultimately going to impact the economy? And the answer is yes, it has to, right? But for the time being, stocks continue to set all-time highs. The top quintile of US households that are seeing their wealth go up and up and up and feeling better about things. And they're willing to spend on whether it be upgrading their homes or leisure travel or whatever, new cars, whatever it may be. And companies are willing to spend to travel and try to generate revenues and all those types of things. At some point, that's going to catch up. The question is, for how long can that top 20% more than offset the challenges we're seeing in the bottom 80?
Yeah, not to get political, but frankly, if you look at history, it not only catches up eventually economically, but politically. I mean, you want to
Mm-hmm.
talk about where revolutions happen is where you have the masses that don't have or feel like they're losing in life. And we, for the first time, I was reading an article, I think it was in the Wall Street Journal, that the generation today, so basically my kids, my 14-year-old son, as he grows up, is less likely to have as much wealth as me.
Mm-hmm.
So we're now into the first generation since before World War One that the next generation is not wealthier than their
Yeah.
parents. And that tends to not do well if you play that out.
It does not. Well, I mean, think about it. I mean, what has Congress done over the past 5 years? Congress can't do anything. They can't even approve a budget without shutting down the government. I'm not a Trumper, but I mean, of course he's going to sign a bunch of executive orders. He can't get anything done if he doesn't because Congress can't do anything. Congress won't even vote on war or not war. Well, let's just kick the can down the road and reset the clock. Even though we have the power of authorizing war or not. So until Congress can get their act together, unfortunately, we're going to be in this big mess.
Well, I'm not going to hold my breath on that one, my friend. If we kind of bring it back to macro conditions, you've got the stock market and home prices that are at all-time highs. What happens to hotel demand if we have a meaningful equity correction? So I'm talking 15 to 20% pullback in the stock market. Do we see then a pullback, you think, in travel because companies and those individuals that were feeling the wealth effect, it reverses a bit?
In short, I would say yes. In long, it doesn't happen right away. It's not like, oh my God, the stock market corrects
Right.
15% and the next day everybody cancels their travel. It takes a little bit of time to materialize. So if those types of corrections hold, the answer is 100% yes.
And then last macro condition, last time you and I talked, we were talking about CapEx investment, AI. You had said data centers rarely generate sustained hotel demand. Has anything changed your view around AI investment since last time we talked?
No, nothing has changed my views surrounding AI investment. Data centers and AI investment, I'm not confident will generate hotel demand. What I will say is that the reality is all this AI investment is generally fueling the stock market, right? It's fueling corporate profits and earnings and stock prices being valued on kind of these forward demand curves that, oh, well, the demand is there, is locked in for the next 3 years. They're at capacity. So stocks should go at a higher price, and that ultimately will translate into higher stock prices translates into all the other things we talked about. But the actual demand being generated by the direct demand being generated by that AI investment, I think, is minimal.
Yeah, so I want to then talk about international travel. You've been one to call out where we've been a huge exporter of travel. The United States has for many years. It's only gotten worse over the last year and a half. Say what you will about the stance of the Trump administration. My opinion is we have a big do not stay here sign. The numbers bear that out. Pre-pandemic, the U.S. was a net importer of 4 million travelers. In 2025, we exported 18 million more than we imported. I'm quoting your numbers there.
Hmm.
It's about 4 points of national occupancy. Massive impact. I think last call you said, hey, it would be great if the administration signaled that we're welcoming for World Cup. That would be like the biggest thing they could do is, hey, come here. That's not happening, except for the executive branch turning over in the next election or Congress getting their shit together, which doesn't seem to be happening. What could the U.S. do to reverse this trend where we're losing a significant portion of travel demand in the world.
Yeah, like, well, just to give you a data point on the opposite direction, the last full month we have data on April was down 10% year over year. Down
Wow.
9.8% international inbound arrivals. That's one data point. I don't like to read one data point into a trend. I mean, the year-to-date numbers were down about 4% through it, but that was a bad month. The Iran war was launched March 1. April is going to be the first month that really starts to show some of those numbers.
What I find always really interesting that if you are right leaning, you claim you're a heavy capitalist. Well, if you're a capitalist, you're for free markets and you're for huge inbound travel to the United States. Actually, foreign inbound travel is one of the biggest trade imbalance benefits we could have because they come here, they stay longer, they spend a disproportionate amount of money versus domestic travelers, and we get all that tax benefit too, all the occupancy tax from those monies that we collect. And so if you're a capitalist listening in and you're not for less visa restricted countries and making, it's almost counter capitalist. That's what I always find really interesting.
I mean, it's true. I mean, no different. If you're right leaning, you're not really a big socialist. But then the Trump administration took equity stakes in how many companies?
Yeah, I always love the debate. I got to go here, even though it's not part of the podcast. I always love the debate with family members that are older and they're staunch Republicans. And they talk about, how negative socialism is. And then I'm like, I bring up Medicare and Social Security being the problems around the deficit. And it's like, well, don't touch my Social Security, my Medicare. I'm like, well, that's technically Social Security socialism. Anyways,
Yeah,
I had to go there.
fascinating.
Sorry. I'll bring us back. So I want to talk about this Skift article that was published in April, got a lot of attention. It's called The Squeeze, Inside the Crisis Crushing America's Hotel Owners. And it talks about how the brand and the owners have diverged, this kind of misalignment of interests that exists in our industry that is pervasive, misalignment of incentives, and how the hotel owner, the heavy asset owner, has seen their margins contract pretty substantially over the last 6-7 years. I'm curious to get your take on the crisis crushing America's hotel owners. I'm quoting the article. That's what it said. So curious to get your take on that perspective.
I have a couple of takes here. First, I'll talk big picture and then I'll get more granular. Big picture is if you go back to the early 90s when Marriott and Host separated, technically Host spun out Marriott, not the other way around, but
Right.
semantics. That basically created the OpCo versus PropCo split and the terms of those franchise agreements. And the big dynamic there were a couple of different things. Number one was the manager and the brand really got paid on the top line, not the bottom line. So they weren't incentivized to generate profits, they were incentivized to generate revenue. Number two, the asset is capital intensive and there was a need to continue to put capital in. And the brands would force show you if you don't keep putting capital in, we'll take the brand away, all those types of things. And they weren't getting any kind of return on that incremental capital, which was another challenge. And as a result, if you go back, and I encourage anybody that's listening, go back and take a look at Marriott's stock chart since the spinoff, which is up several thousand%, and compare that to Host's, which is basically flat or even down.
Yeah.
And it's a great example of the economics and the business float.
To that point, I had to jump in there. They did the comparison. So when Hilton spun off Park into the REIT in 2017, so since 2017, Hilton stock is up 468%. That's as of the publishing of the article. I think it's actually up even more now because it's gone up in the last month. And Park is down 22%. So if you put in $1 in 2017 into Hilton, you would have close to $5. And if you had put $1 into Park, you'd have 78 cents. So talk about, and that's just since 27. That's in the last 9 years. Yeah.
Yeah, it's a challenging dynamic. So I think that, that's the first issue is that the interests clearly are not aligned. The economics favor the brand and operator far more than the owner. And then the other side of that is we are in an environment where we have material cost increases. And this isn't just for hotels, but all real estate, insurance growing at exponential levels, property taxes increasing dramatically, and none of that impacts the operator or the brand. So those create issues. And then you layer in labor components, and I'd be remiss if I didn't talk about what's happening in labor today. I think it was last week maybe the week before, New York struck their union agreement, which was super weird and what I would refer to as a win for both sides, only because it could have been so much worse. 6 months ago, I thought for sure we'd be in a strike in New York during the World Cup. Instead, New York agreed to an 8-year contract with a 50% increase in wages and benefits that are growing dramatically to the tune that the Hotel Association of New York said that incremental labor costs will be 15% over the next 12 months. So that's a massive increase, right? But at the same time, they didn't get a strike. They didn't get a short-term deal that would have aligned the union nationally in advance of the Summer Olympics in 2028, like the union was fighting for. And they didn't get kind of, 10+% per year increases like we had seen in some other markets. So, wasn't so bad, but much longer, much higher benefits expenses. The union employees have to feel pretty good about, oh, this is going to be way better for me. And the owners have to feel pretty good. It could have been so much worse. But the reality is when we're talking about it could have been worse than 15% increase over the next 12 months and 50% over 8 years, that tells you the world we're living in from a labor cost perspective that
Well,
like, how do you keep pace with that?
you can't. You just have more value leakage go away from the hotel owner, right? That's the natural answer.
And it doesn't
I'm
impact
sure.
the operator or the brand.
Yeah, it doesn't. They get paid the same and their employees
Hmm.
make more. It basically transfers value from the hotel owner to the
Yep,
associates themselves. If you game theory out, though, if you have so much value transfer to labor, eventually you have hotels go out of business and there's less jobs. And then, frankly, where do you see automation happen the fastest? You saw this in the car industry. It's actually where the highest cost of labor is where you see automation and jobs be fully automated. And you would argue eventually if the collective bargaining agreements are so egregious towards the labor side, that's where you'll actually see eliminations of jobs. Robots cleaning instead of housekeepers faster.
totally agree. And I think it's a big challenge.
Yeah. One other take on the ownership side, I think it was the IHG global CEO at Alice that said, if somebody isn't willing to be the asset heavy owner, then none of us can be asset light. The game stops. Um, when do you see that game stopping? Because you see like Booking.com, Expedia hitting all-time stock highs, Marriott, Hilton, both in the last couple of weeks. You've seen some huge tech raises like Muse and some others charging SaaS fees. Basically, everyone that doesn't own the hotel is still feeling pretty good about life. When does that carousel stop?
Well, I mean, along with what Teague said, hotel values are cyclical and they go through cycles of on the way down and then on the way up. We do think values will increase over the next 5 years. I think our new forecast has a 9% increase in values on average across the US. Some markets way better.
And that's interest rate independent. So that's not assuming rates come down.
That's not assuming rates come down. We do not assume rates come down. Even if the Fed lowers rates at some point, that usually happens with spreads expanding. So we actually have cap rates rising about 30 bips over the next 5 years. It's not interest rate independent, but it's not being driven by lower interest rates. It's being driven by modestly increasing cash flows. But at 9% over 5 years translates into 2% and change, which frankly is going to be below inflation and probably below what your benchmark investment could be on almost anything else. So that, yeah, it's positive, but it's not good. Like Teague said, we're coming off of a bottom, and the next 5 years on that upcycle is going to be below inflation and below alternative investment opportunities.
Well, it speaks to when I had him on, he talked about the prevalence of debt and the lack of equity. And I think that speaks to that, right? That, if you're a Blackstone or an Oak Tree or a KKR, your alternative use for those funds, you can go into industrial that's been booming or multifamily or non-real estate. I think that the alternative use, at least on the equity side, is definitely a challenge for those that are hotel equity owners.
Mhm. No, don't get me wrong. I think there are still places that you can make a lot of money investing in hotels. We talk about things on a national basis, but I think there's a huge dichotomy, in my opinion, between investing in a market like Orlando and investing in a market like New York. We love Orlando. Top economic growth, great convention calendar, I think up 16% this year and another 16% next year. Every year over the next 5 years is at least 25% above 2019 levels from a convention basis. If international travel is going to come back at some point, Orlando is going to be a huge beneficiary of it. You put all those things together, and oh, by the way, almost no supply growth. That's a pretty good recipe, and it's a low cost, low operating cost environment. Translate that to a New York that's kind of boomed coming out of the pandemic, and you're now seeing wages going up dramatically. we move past the World Cup and you have all these comps, difficult comps from special events that have played out over the past couple of years. New York gets much more cautious. So not every market is the same. That's what I always tell our clients is, hey, we can talk about things on a national basis because that's helpful to think about it and give you your benchmarks. At the end of the way, you're not investing unless you're buying a portfolio. You're not investing, on a national basis. You're investing in a given asset that has a given story.
Yeah, so you already kind of went there. I want, if we talk about kind of cap rates, transactions, values, I guess where I'll start is kind of a follow on. You have your bottom markets for 5-year value change. I'm quoting your investor letter.
Mm-hmm.
Dallas, Washington, D.C., New York, Chicago, Detroit, and then top markets for 5-year value change, Orlando, New Orleans, Miami, Anaheim, Tampa. You also had referenced Palm Beach. I don't think that was in the top 5, but maybe that's just a sizing issue. What is driving that difference? And then why are you so bullish on some of these other markets around hotel values?
Well, let's talk about the ones I like first. I already
Okay.
talked a little about Orlando. New
Yeah.
Orleans, we mentioned. We think that's a totally misunderstood market. New Orleans is a convention center market. 9% of their demand to that market is corporate transient. It is convention and leisure, plain and simple. It's not high-end leisure either. That's a market that lives and dies by the convention calendar. When the convention center is going well, it drives pricing power across the entire city. And when it's not doing well, it doesn't. Well, last year, the convention center outside of the Super Bowl was down pretty negatively. This year, it's up 7%, including the comp against the Super Bowl. Supply is actually declining this year, and it's very, very muted with just a couple of hotels under construction over the next 5 years. It's got a super low wage environment. I think it ranks 22 out of 33 markets we track wage growth on over the next 5 years. So you put all that together, and we think it's kind of a misunderstood market, whereas the convention center does better, which we will see. And supply growth is really, non-existent, declining based on a couple of recent closures. You're going to see fundamentals turn around, and then that sentiment's going to shift pretty meaningfully. And that's a market that's going to be really good for investment. Miami is another one we really like. Again, we think international travel has to improve from the levels that we're seeing now. But until then, you have the World Cup later this year. You do have difficult comps next year with the World Cup and the College Football Championship earlier this year. But, we generally think that everything going on in Miami being the, capital of Latin America is going to boost top line performance. Wage growth isn't crazy. Being in Florida, we feel pretty good about that one. Tampa's another one. Florida, low wage growth. Got really soft comps tied to the hurricanes. We think you're going to see strong economic growth driving ADR really high. It's one of our top 10 for ADR growth over the next 5 years. And then low labor costs brings it into the top 5 for EBITDA, which drives values. Anaheim was the last one that we mentioned in our client letter. That's going to actually benefit from the special events in LA. Because it's so close. So think the World Cup this year, Super Bowl next year, and the Olympics in 2028. As I talked about, international travel eventually going to improve. That's positive for Anaheim and Disney. And a falling dollar will help. Strong convention calendar, again, up 15-16% annually this year and next year. There's no supply growth, just 0.3% of existing inventory is under construction today. Not an easy market to build in either. And that leads to kind of top line growth in the top 5 or so across our markets. So it gets us pretty positive. While expenses are higher, I actually assume Orange County, Anaheim is #1 for expense growth over the next 5 years. It still translates into strong values because of the strength in the top line. I talked a little about Palm Beach. Others we like are Sedona, Raleigh, Fort Worth, Maui. We think are all really, really good. But those smaller markets we don't highlight as top for investment. And then the ones to avoid, New York, Chicago, and DC can all get lumped into that same expense dynamic that we talked about. Those big blue cities have really high expense growth, and that's a really big challenge.
Yeah.
And the revenues just can't keep pace.
Right.
So when you think about those 3 big cities, that's very clear. DC also has the element of reduced government function, government travel, risks of more government shutdowns, which continues to unfold, which puts a strain on the DC market in general. So all those things are really soft for DC. Detroit, a little different. Detroit is a supply issue. There's a lot of supply coming up in Detroit without a lot of economic growth, corporate demand trends, all those types of things, which is really, really challenging.
I wonder if that's driven off of tax incentives because a lot of those gentrification cities give a lot of tax incentive, and then the developers just treat it as equity, and so you have like all these projects that would never get financed off of
Oh,
tax incentives.
totally. That's exactly what's happening in Detroit,
Yeah.
and it's a big challenge there. I mean, they're gonna host the Final Four in a couple of years, and that'll be a big pos or not next year, 2027. So you've got all this supply rushing to get open in advance of that, And frankly, the Final Four will probably be a home run for that city, but
That's a
that's a
one-time
one-time
event.
blip. And then this supply is permanent, and there's just way too much. And I think it creates a huge strain on that market. And then Dallas is a different beast altogether because Dallas isn't a labor cost issue. Dallas isn't an economic growth issue. Dallas is a location issue. The Dallas market is moving away from downtown, whether going towards Fort Worth or the northern suburbs. I think the last big announcement was AT&T moving out of
That's
downtown.
right.
The convention center is under the knife for the next few years, so you don't have the convention center tailwinds. Basically, what's happening is downtown Dallas is turning into a dearth of demand generators. The outerlying areas may do okay, don't get me wrong, but as a market overall, with all that inventory downtown, that has a big portion of overall performance. That downtown is going to stink, which is going to weigh on the broader market, but it's also going to, create far less compression and force, limited pricing power because downtown, if you're running at low occupancy levels, you're going to be discounting to try to bring people down there. I'll never forget, but over 20 years ago, I appraised what was then the Adams Mark in downtown Dallas. Do you know what the occupancy level of the Adams Mark in downtown Dallas was? Mind you, it was like 2,000 rooms at the time.
I do not.
23%.
Wow. Holy
Yeah.
smokes.
Yeah. I mean, like when you have hotels running super low occupancies, they're discounting like crazy just to get anybody. And that's where if you're Dallas downtown is going.
Yeah, the city definitely has some serious challenges, and I live in Knox Henderson, just north of downtown. The city has got all kinds of funding issues. Yeah, don't get me started.
We've got our GNP growth for Dallas is number 9 of 64 markets we track over
Yeah,
the next 5 years. It's not an economic growth perspective. It's
right.
just where that growth is.
Now, last time you and I talked, we talked about public REITs and a broken model. Hotels are only 1% of the NAREIT index. The duration mismatch that is a fatal flaw of the model, et cetera, et cetera. Has anything changed your view?
Definitely not. Being a former REIT analyst and working for one of the large REITs, I wish I had a different view on it.
Yeah,
I just think it's really, really hard. I think that dynamic has just shifted where the investor in the hotel REIT is not a long-term investor. They're very short-term, and the assets that REITs hold are very long-term, and that is a very challenging dynamic to be in. And when you're 1% of the index, nobody has to own you, so you don't.
exactly.
I think that world has shifted dramatically. I mean, I use the example all the time. When was the last time a hotel REIT went public?
Exactly.
I think the last one was probably Xenia.
Yeah, I think you're right.
I think the
Well,
last
you
one was
definitely have
probably.
a bunch of them being delisted. Well, you've got Braemar selling all their assets, and then what's the small REIT that got taken private? I'm totally Southerly.
Southerly, right?
Yeah, I tend to think there'll be a lot more take privates, but we'll see.
If you have a board and a management team that's willing to sell, but in a lot of cases that is not, which makes it
Yeah,
really hard. I mean, I think what's also fascinating is look at just what happened in the apartment sector, right? I think the two largest apartment REITs, right, Equity Residential and Avalon Bay merged to create a behemoth in the multifamily sector that now every REIT dedicated investor has to have in their index. They don't have a choice. There is no hotel stock that every REIT dedicated investor has to have in their index. So,
totally.
maybe there's also opportunities for public to public M&A, not just public to private.
Yeah, we'll see. We saw a few back in the day. It's possible.
Yeah, those few back in the day were really driven by activists, though, right?
Yeah, that's right. Well, we've come to the point of the show that we like to do rapid fire. You're familiar with it. I'll throw you a softball to start. Over or under U.S. RevPAR growth for full year 2026, and I'll set the bar at 3%.
Over.
Over. I like it. The optimism continues. Although it's sad that we're in an environment where more than 3% we get giddy. That tells you where we've been the last
It's true.
year or
It's true.
two. Single best hotel market for investment for the next 5 years, and you can only pick one.
Orlando,
Okay. The worst, and you can only pick one.
Dallas.
My hometown.
Sorry.
That's all right.
It'll get better eventually, but you got to get the convention center.
Agreed. Does a major hotel brand acquire another major brand in the next 2 to 3 years?
I think it depends how you define major, but I'll say yes.
I'd say any of them have a public market cap of 5 billion or more, and I think that basically starts with Choice, and you go up the food chain. So
Yeah, I think there will be some type of combination. Yes.
yeah. What do you think happens? I guess a follow on to that is you look at Choice and Wyndham, particularly, they have a huge exposure in economy and mid scale and
Hmm.
almost none in upper upscale and luxury, which is what's growing. How do they evolve where they've got these limitations?
Yeah, I think it's been hard. I mean, I think Choice tried to merge with Wyndham to try to create some synergies in a really challenging revenue growth environment for them, and that failed. And now the CEO is gone. Meanwhile, Wyndham's CEO is on leave. And Jeff, we hope you're doing well. So, I think that it's hard to know. I mean, I'm not sure that combining those two companies is the right answer, but I do think both those companies need to do something, whether that is combining and eliminating your biggest competitor, or it is to create more scale and synergies, or it's about trying to go more upscale. And it's really hard for lower tiered brands to move upscale. It's
Yeah,
much easier for upper scale brands to move down than the other way around because of the
exactly.
type of consumer.
It would be a natural for a core because they have no scale in North America to pick off one or both, or maybe it's a
Mhm.
pairing with IHG that makes that portfolio more relevant. I'm convinced if they're to survive over the next decade, there's got to be some type of M&A catalyst.
Yeah, I don't necessarily disagree. I think there have to be some different things. I think the reality is the strategy shift, and they have to. The reality is Choice and Wyndham are both great companies, and they've grown, and they are formidable in the sectors that they operate in. Unfortunately, those sectors aren't doing great, and
That's right.
diversification will be a huge positive.
Hotel industry in 2030 still defined by international travel not flowing into the US and flowing out.
No, I think things will turn. I think a falling dollar coupled with numbness to some of the negative rhetoric coming out of DC, coupled with, a potential turnover in government, whether that be at the president or Congress, between now and then, will shift a lot of that.
Got it. And then you got your investor letter coming out next week. One key number you'd call out from that.
Oh boy, that's a great question. I think the number is one we talked about before, which is 9%. It's our value appreciation over the next 5 years across the US. And I think it points to, hey, things are growing. Great. That's good, but below inflation. That's not
Yeah.
great.
Well, Ryan, always a pleasure to have you on. I could talk to you all day. Appreciate all your insights. Ryan, what are you not done with, my friend?
I am not done spending time at my place in Vermont for the summer. I'm looking forward to
Nice.
getting up there and enjoying some time in nature. So,
I love it. My wife and I just went to Tahoe a couple days ago for my 45th birthday, and it snowed. May 26th is my birthday, and it was the first time I'd ever seen snow on my birthday.
well, there you go.
Yeah. Well, thanks for being here, my friend.
My pleasure.